Too clear. I could hear breathing. Slow. Careful. Controlled. Not animal breathing. Human. I installed cameras again. Same cheap setup as before. Living room. Hallway. Kitchen. I didn't bother with the bedroom. I didn't want to know what I'd see there. For several nights, nothing happened. Then, at 2:13 a.m., my phone buzzed. Motion detected, hallway. I opened the feed. The hallway was dark, lit only by the nightlight near the bathroom. Everything looked normal. Then I noticed something that made my stomach drop. The wall was moving. Not much. Just a slight bulge near the baseboard, like pressure being applied from the inside. It slowly receded, then returned somewhere else, higher up. I watched as the drywall flexed inward. Something was behind it. I grabbed my keys and left the house. I didn't even shut the door. I sat in my car, shaking, watching the camera feeds until my phone battery dropped to single digits. The police came the next morning. They searched the house. Tapped on the walls. Looked confused. One of them joked about mice. Another suggested raccoons. I told them about the breathing. They exchanged looks. Eventually, they left, telling me to call again if I heard anything louder. Something more definitive. That night, I heard knocking. 3 slow taps from inside the wall. Tap. 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 Then silence. I slept in my car. The next day, I tore part of the drywall open myself. Just a small section behind the couch. What I found made my knees go weak. There was a gap. This is where the war begins. Governments prefer low yields. It gives them fiscal space. They can fund infrastructure, social programs, defense, stimulus. They can postpone hard decisions. Bond markets prefer credibility. They want assurance that they'll be repaid in real terms. That inflation won't erode returns. That deficits won't spiral. That political promises won't outpace economic reality. When those preferences align, borrowing is smooth. When they diverge, tension builds. Let's rewind to a moment when this tension became visible. In the early 1990s, several European governments were struggling with high deficits and inflation concerns. Bond investors demanded higher yields to compensate for risk. Countries pursuing monetary union had to prove fiscal discipline. Markets forced reforms. Governments cut spending, raised taxes, and reshaped policy, not purely out of ideology, but because borrowing costs left little choice. Fast forward to 2010. Greece. For years, Greek government bonds traded at yields not far from Germany's. Investors assumed implicit support within the Eurozone. Risk was underpriced. Then doubts surfaced about fiscal sustainability. Yields surged. Not gradually. Violently. At one point, Greek 10-year bond yields exceeded 30%. At that level, borrowing becomes impossible. It wasn't voters who imposed austerity first. It was markets. Now consider a more recent example. In 2022, the United Kingdom announced a sweeping fiscal package of tax cuts without clear funding. Markets reacted instantly. Gilt yields spiked. The pound fell sharply. Pension funds faced margin calls due to leveraged bond strategies. Within weeks, the policy was reversed. The government blinked. The bond market did not. This pattern repeats across history. The details change. The mechanism doesn't. Governments issue promises. Bond markets price belief. And belief can shift quickly. Here's the uncomfortable math that fuels this war. Debt sustainability depends on one critical relationship: the interest rate a government pays versus the growth rate of its economy. If the economy grows faster than the interest rate, debt can stabilize or even shrink relative to GDP, even with moderate deficits. If interest rates exceed growth for a prolonged period, debt compounds. Faster and faster. For much of the 2010s, advanced economies enjoyed unusually low interest rates. In some cases, negative rates. Growth wasn't spectacular, but borrowing was extraordinarily cheap. Governments refinanced debt at minimal cost. Central banks purchased bonds through quantitative easing, suppressing yields further. It felt manageable. Some argued debt no longer mattered. But low rates were not a law of nature. They were a condition. When inflation surged in the early 2020s, central banks raised rates aggressively to restore price stability. Bond yields followed. The risk-free baseline shifted upward. And suddenly, the arithmetic changed. A country rolling over hundreds of billions in debt each year doesn't feel rate increases immediately. Old bonds mature gradually. New ones are issued at current yields. The cost creeps upward. Quietly. Relentlessly. Politicians can delay. They can hope for growth. They can rely on optimistic forecasts. Bond markets are less patient. If investors believe deficits will remain high and inflation risks persist, they demand higher yields now. Not later. They price in future risk today. And that pricing itself creates pressure. Higher yields increase deficits through higher interest payments. Larger deficits can further undermine confidence. That can push yields higher still. It's a feedback loop. In extreme cases, it becomes self-fulfilling. This is why credibility is a government's most valuable asset in bond markets. Not slogans. Not speeches. Credibility. Now here's where the story becomes more subtle. Bond markets are not a single villain in a dark room. They are millions of decisions aggregated. Pension managers balancing liabilities. Foreign central banks managing reserves. Hedge funds seeking arbitrage. Insurance companies matching duration. But collectively, they act like a single force, disciplined, unsentimental, focused on risk and return. Governments, by contrast, are political organisms. They respond to voters, to election cycles, to social pressure, to crises. Short-term incentives often conflict with long-term fiscal prudence. Raise taxes? Unpopular. Cut spending? Unpopular. Borrow more? Convenient. Until yields rise. This is the irony. Democracies promise benefits in the present. Bond markets price obligations in the future. The conflict is structural. Sometimes, central banks enter the battlefield. If bond yields rise too quickly, threatening financial stability, central banks can intervene. They can buy government bonds. They can signal support. They can cap yields, explicitly or implicitly. Japan has done this through yield curve control. The European Central Bank has created tools to prevent fragmentation within the Eurozone. During crises, the Federal Reserve has stepped in to stabilize treasury markets. When central banks buy bonds, they suppress yields. That eases pressure on the governments. But it also blurs lines. If markets believe central banks will always step in, risk premiums shrink. Governments may feel emboldened. Debt can accumulate further. The quiet war becomes a three-player game. Governments. Bond markets. Central banks. Each watching the others. Each testing limits. Publicly, the narrative often centers on politics. Election battles. Budget debates. Party ideology. Underneath, bond yields move in real time. A government can announce a multi-trillion-dollar spending plan to applause in Parliament. Within minutes, bond traders assess the implications. Is it growth-enhancing? Inflationary? Sustainable? If skepticism rises, yields edge higher. Not as protest. As pricing. And pricing can constrain policy more effectively than opposition parties ever could. This doesn't mean bond markets are always right. They overshoot. They panic. They misjudge. They follow momentum. But they have leverage. Because governments need continuous financing. Modern states don't operate like households paying off mortgages over time. They roll over debt perpetually. Bonds mature. New ones are issued. The stock remains. Access to markets is oxygen. Lose it, and options shrink fast. Consider emerging markets. Many borrow in foreign currencies. When global interest rates rise, capital can flow out rapidly. Currencies weaken. Servicing dollar-denominated debt becomes more expensive. Yields spike. Governments face stark choices: austerity, restructuring, or inflation. But even advanced economies are not immune. The scale is larger. The timeline's longer. The constraints softer. Yet the mechanism is the same. Here's another layer rarely discussed openly. Bond markets are forward-looking. Elections are backward-looking. Voters reward recent improvements. Politicians campaign on visible achievements. But bond investors analyze 5, 10, 30-year trajectories. Demographics. Productivity. Structural deficits. Pension obligations. Healthcare costs. They ask, what does this country's balance sheet look like in a decade? If the answer is murky, yields adjust.